Good morning, class. This is your instructor. Today I'm going to be talking about some of the stuff that was left behind from previous lecture. These were primarily some of the practical problems that we were facing. Now, we did, if you recall, some of the brief exercises from Williams, Haka, Bettner, Carcello's Financial and Managerial Accounting book. This edition that we're doing is 18th, and I've also planted that in the description box. Now, when we look at the problems, so I'm going to be doing a few of them so that you can just see how generally they are attempted, and then you can do remaining problems as well as part B of this. This is chapter 14, and we are doing retained earnings. When we talk about retained earnings and the income statement, last time we did uh, the common size analysis, then there was also the horizontal analysis when there was a trend analysis comparison from the past years, and then there was a dollar change, percentage change, and so on. So now when we talk about these questions, I'll be just going through one or two questions and reading them a bit. I'll just increase the font now. Okay, I hope that you can see it better. Alright, so I'll just explain the questions to you, first of all, and then I'll have to switch to the board, and then you'll have to just, recall from what I just explained to you at the moment. And I'm also going to be putting this as a separate question in form of a slide. So now this is when you compare basically operating results with average performance in the industry. So like I told you that when we talk about average performance, it means the similar product that you're selling is also available with other shopkeepers, factory suppliers. So when we want to monitor the performance or the comparative results, comparative operating efficiency of one company with regards to the other, then we look at what is the industrial average. And when we talk about industry, it means what other sellers selling the similar product or substitute, they are how they are performing and what they are making out of their you know these selling of the inventory. So in this case, you have a cash flow. Steady cash flow is very important. Now they've given you, as you can see, this is my arrow now. This is industrial average, which is 100%, means that you are dividing just because now this is going to be a vertical analysis in a way. And this is a common size summary. So I'm just going to highlight this. Now as you can see, this is you can see this is a common size summary for the industry, right? So whenever we get this common size summary, we are to compare from one main figure that we keep as a base, and then you're going to be keeping that as a denominator, and then you're going to be finding out the percentages. So you can compare with industrial average and see where you're heading. So what we are going to do is, for common size summary, we just have the sales. And then, first of all, they've just 100% would actually mean that you're just dividing sales by sales, and you have cost of goods sold. So we're going to be individually dividing all these with a common base of this being as a percentage of, so each individual item being the percentage of the sales figure. So then we also have been given return on assets in this case, and we have net income. So we will find out how our company is performing in this case. We have the data and to compare the operating results of Outdoor World Incorporation, or Incorporated. So when we are to comment, then we will find out what is the difference with respect to the industrial average in this case. So they have not given us all the things, especially they have not given us the value of assets. So, but we do have the return in this case. And then we can just simply find out what are the disparities, what are the differences, and where are the weaknesses, okay? And then we can improve on those. The next question is about, analysis to identify favorable trends. Now we are to compare trends from the last year. and they're asking us to find out the net sales. So you have missing figures here. So you can find out net sales very easily, guys. Just have net income as a percentage of net sales here, okay? So as you can see that this is a percentage of net sales. So what you're going to be dividing is basically net income. So you would have divided it by X to find out 6%. So now we are going to be dividing it by 6% to get X. That would be our sales in this case. So once we have our sales, then we can find out the cost of goods sold by subtracting the gross profit from here. And after this, we can have, after the gross profit, we can compare whether this was better or the last year's one. Apparently, as you can see, the gross profit on sales for 2018 is a bit lower than that of 2017, but then we can find what is the cost of goods sold pertaining to that. And we can divide or subtract that from the net sales figure to find out the cost of goods sold, yes, in this case. And we divide this by net sales to find out the percentage. Similarly, we have the dollar operating expenses and as a percentage for each year. So now operating expenses, basically you just have from the gross profit, you can just subtract income before income tax. So you can just find out what were the operating expenses in this case. So you will be knowing all those because you can either subtract net operating the operating expenses to find out the income before income tax, or you can subtract the income before income tax from the gross profit to find out the operating expenses. Then you can have a condensed. Now, I already discussed this in the last lecture. What's condensed comparative? It means that you can have one consolidated company figures, financial figures, once all your subsidiaries post the data to you. And in this case, we can have a comparative result for, so this is basically not consolidated, that is rather condensed in the sense that you're giving one big picture. So had it been for different subsidiaries giving you the same figures, then it would have been consolidated. So basically condensed and consolidated in a way is the same, but since we have not been given any further information, so without further ado, I'm just going to be talking about what data immediately is available to us, and then we can just go on and proceed from there. So we can find out whether it's favorable or unfavorable, and then we have okay, so now this is just a bit about current assets and liabilities. We all know what are current assets and current liabilities. We've already done that. And in depreciation chapter, I think that was chapter 9, and chapter 10, that was about liabilities. So need not go too much into detail with this portion. What we can do is, for this portion, we can quickly just look at the key figures we would be requiring for the current assets as well as the liabilities, as we all know. So what are the key figures that you'll be requiring? As you know, we need cash as current assets. We need, we can have marketable securities. But we need, this is the liability. We don't need retained earnings, and we don't need accumulated depreciation at the moment. And we have income tax payable. Accounts receivable is also asset. We have inventory, and we have unexpired insurance. Okay, guys should know that unexpired insurance is basically sort of like your prepaid expense. So prepaid expense, till the time it has been completely consumed, is your current asset because you pay in advance for something you haven't received service for. And then you have unearned revenue, which is your liability. So there are two things. One is unexpired insurance, which is some sort of like unused thing that you pay for. So it's your asset. But when you talk about unearned revenue, that is, you haven't earned something, but you have received money for it. So it's your liability. You have to give service for this. So then all these payables in the short term, like salaries payable, income tax payable, accounts, So this unearned revenue, and then you have notes payable. So these will be your liabilities, current liabilities, and we have cash, marketable securities. Then we have accounts receivable, inventory, and unexpired insurance as our current assets in this case. Okay, so now we have other problems as well, but we do this part and let's just begin with this. So you might not be able to see the questions now because I'll be single-handedly attempting this, so I have to switch to the board. And so let's just move to the board now. रिकॉर्डिंग लगा आइटम क्या आ रहा है ठीक है Okay class, so now we're going to be talking about the questions one by one. We have first question is 14.1a, Outdoor World Inc. manufacturer. So now we are going to be taking the industrial average. As you can see that we have the first figure is 20 million, right? So now I'm going to be doing some rough work here. So it's 20 million, or I can just maybe just have the net sales. Okay, so we have 20 million. And the next is cost of goods sold as 9.8 million. So, well, I'm just going to be writing that here. Net sales, cost of goods sold, or just simply COGS, 9.8 million. And then we have operating expense as 10.2 million. So OE 10.2 million. So I'm going to be writing one by one all, and then we can just simply okay, so we have selling as 4.2 million. Then we have general administrative as 3.4. Okay, guys. I hope the figures are clear to you. So now we have operating expenses at 7.6. And operating income as 2.6. 2.6 million. Then we have income tax expense as 1.2 million. I'm going to be writing this all so that it's more clear to you. So we have 1.2 million. Okay, so now we have net income as 1.4. You can just draw a line here, and then you can just subtract this thing, and then we can have net income as this 40 million. Okay. Now, as we already know, so this is cost of goods sold, and then we have operating expenses, and we have selling, G&M. So operating expenses. So we can have operating income like this. So we can also have gross profit. I think they have mentioned this. It's 10. Cost of goods sold is 9.8, and gross profit is actually 10.2. So this is gross profit actually. This is gross profit, and we have then operating expenses as selling. So these are our operating expenses as selling, G&A, and then we have the total operating expense as 7.6. This is the total. Okay, so they have given us a multitude of factors here. We are to compute the individual percentage of each, and we can also find out the industrial averages here, but what we are to know is what the percentage for each is for outdoor world at least, and then that is the industrial average. Okay, I'm going to be dividing now one by one so that you can also see each and every step. So first of all, both of them are at 100%. That is easier to determine just by looking at this. Then we have cost of goods sold. So now we have 9.8 by 20, 0.49, and which is the industrial average is 58. So we are going pretty good actually, because see over here this is way more for cost of goods sold, and we are doing much better than that. And we have 10, so, and then we just divide this, and here we have 0.51, 0.51, and the industrial average in this case is 0.42, or you can just simply say 42%. Then we have selling, 4.2, that's 0.21, and the industrial average is 16% or 0.16. And if you have any issues with the decimal, you can just simply put a percentage for you to be more perhaps lucid about this. Is 21%, this is 16%. Then we have 3.4 by 20. Then we get 0.17. And this one is, okay, so which one is this? Is GNA, right? So we have 20. This is 0.2. So our company is performing actually pretty good. It's performing really well. So then we have, next is 36% for total. 36, and you can just simply see that this is 20 plus 16 is 36, so we have 38.3. Let's just also do it by the regular method, and so it's get 0.38, so it's just the same thing. You just either just add these two, or you can just simply divide this by the other value, main value, net sales, and you get 0.38. So we can say that our expenses are slightly bit higher because of, and this operating expense, more than offsets, the reduction in, or maybe the offsets, first of all, what you're offsetting is the gross profit increase in gross profit. So one is the gross profit, and the other is, as you can see, we have general and admin expenses, so we also have cost of goods sold. So I can also write the cost of goods sold reduction. You can on top write cost of goods sold and then go by about with gross profit. And then we have third thing as you can see G&A reduction, and so on and so forth. So now you can just analyze accordingly that, so even though these things are giving us benefit, or we have an edge over the industry, however, since our operating expense has not been able to counter that, it could be because of the selling expenses, because our selling. So we can say that the marketing strategy or marketing expenses are the main reason for higher operating costs or operating expenses. Okay guys, I'm just using at this moment interchangeably, but you should know that there's a difference between cost and expense. Expense is something that you can maybe offset in the current year with revenues, but cost is usually, is part of the product, main product, and it's a factory cost coming from when you are doing the manufacturing. So it's just a main manufacturing process that is taking place. So For instance, you have direct material, direct labor, and other factory overheads. So that could be the cost of goods sold. But so I'm not saying that this is actually that cost, okay? So I'm just interchangeably using it right now, but just know that this is actually operating expense. So we have now operating income. It's 2.6 by 20. And here we have 0.13. Now, what is our industrial average? It is 6%. That is 6% actually. So, see, we are actually way ahead from the other companies that are in the same industry selling the same product. Then we have income tax. Okay, so I don't think we can have an edge over the income tax because percentage is the same, okay? So I don't know, it's 6% actually, so 6% here. And its industrial average is 3%. Yeah, perhaps because our income tax, that whatever that we have calculated is just 1.2 million. It comes to about that of net sales, but usually we can't really say that we have edge over the income tax. It should be close to about 3%, but there's an anomaly here because of perhaps maybe the net sales are inflated because of there could be just inflationary aspect to it. So that is why the percentage is seen as more. And then we have net income. Okay, so we have operating. It's not very clear. We have operating income, income tax expense. Then we have net income as 3%. So let's just divide this. We have by 20 million again, and you have 0.07. Again, we have more net income. So guys, don't get confused with the income tax thing because I've already told you this maybe because of the reporting of net sales. We have more sales, so we have more income, but income tax has been perhaps given more. It could be due to many reasons. Either that we have not, the percentage actually should remain the same though, but the reason could be that the percentage is always the same, but then they have perhaps given slightly more for some reason, and then we can't just simply compute or show income tax based on what the result is showing us here in this case. So as you can find out that it's because of inflationary aspects, and so we can also have inflated income and lower costs, and then we might be paying from the deferred taxes from last year, so maybe perhaps it's showing us more percentage. So well, whatever that we have, since it's an income statement and we are just to find out the percentage, this comes to about this, and yes, the same. Similarly, we have overall edge because we have net income, which is again 7% compares to about 3% here. So overall, the company has an edge, it's performing well. So what you analyze is that there could be inflationary aspects explaining the income tax. They have asked us, as a matter of fact, let's just see, the third part is a net income return on assets suggests possible reasons for more important disparities. Yeah, so the disparity, one of the disparity that I find is income tax, which is not easy to explain in this case because you have to have the same percentage from previous years, hasn't changed, or unless the percentage has changed from last year, then this could be one reason of disparity. And the second reason could be that there are inflationary aspects and you are paying more tax somewhat, and it is showing as a uh, more as a percentage of the sales, but really it's just equivalent to this value because you have been probably the rate that you're giving is more because of the inflationary aspects. And then the other fact is that we have net income. So they have actually not talked too much about why we have this disparity, but usually this would not be counted as the productive activity of the company, and we're just going to skip this portion. We have net income, and this is the main thing, that it is performing well above par to the industrial average that we have. So overall this company is good. Its performance indicators are uh, showing a strong company, and also having operating efficiencies far beyond that of the industry. So we can just skip this advertising expense as a selling expense being more, because that could explain why the company is selling its goods at their own premium prices. So now for you have cost of goods sold as being lower and sales are pretty much good. So the reason why, even though the cost is in here, you can see higher, and in here low, but we have gross profit as far more, even though we have higher selling. So that means that we are actually giving them premium prices, or price of our own choosing. So this is price, which is of own choosing. So it is of own choosing, and this is a premium price, okay? So now you get this analysis, similar pattern you have to do in the exam. I'll just come to question 2 now. So we are to find out the missing values in this case. I'm going to be rubbing this question. Okay guys, we'll talk about the analysis for missing values, and for this company, which is Donaldson Inc. or Incorporated. At the beginning of 2018, the company's former supplier went bankrupt, and the company began buying merchandise from another supplier. So now gross profit on sales, so we have gross profit as 1008 or 1.8 million, 8,000. So I'm going to be writing this for your own understanding. So we have 2018. But just to find out the missing values, they have given us gross profit on sales. So we don't have, now they've asked us to compute the net sales, okay? So I'm going to just leave whatever we have to find out as a question mark. And we have gross profit as 1, 8, and 1,000. Then this as 252. No, this is 1,134. And then we have income before income tax. Okay, so now we can have a cost of goods sold is also missing for us. So then we have cost of goods sold determined, and I think I'll have to keep it a bit below. So this is also not known to us. So we'll just put this, and so yeah. Okay. Then we have income before income tax. Then we don't have operating expenses, okay? So we have to find out operating expenses, and then we get income before income tax. Income before income tax. This is for income tax, okay? Which is 230400, and we have 252,000. Okay. Then we are to find out net income, which is 172,000 in this case. Percentage, okay, we have to find out the percentage. But our prime focus is that we need to find out these unknown figures because the remaining ones are known to us. And then you can just simply find out the way we did in the last question. Net income as percentage of net sales is 6% and 7.5%. They have given us net income as, so why do we need net income? So we don't even have the value for income tax at the moment, but 172,800, we just find it out from here. And this is 189,000. 9,000, and the gap would actually explain to us the tax that is missing. I'm just actually getting short space, so I'm just leaving this out as separate. We have percentage of net sales, net income, as percentage of net sales, okay? So net sales, I've already explained to you, this is just sales, gross sales minus the sales returns that we have, because it's not possible to sell sometimes 100% of the product. So you can just go to some grocery store, you will always find out that when there's some unsold milk, especially perishable products, or something which is not selling, they just return to the supplier. So those sales are actually subtracted. And sometimes they also subtract the credit sales, the ones that have gone bad. So now we have net income. Okay, so it's very easy because they've given us 6%, I think 6, yeah, and that is 7.5%. So you have to find out. So basically what this says is that net income as a percentage of sales is 6%. So it means that 172,800, okay, by X is actually 0.06. So then you just take it as by 0.06 and you'll get X. And that'll be your sales in this case. So we do divide this. So we have 172,800 by 0.06. I have 2880. So now it's 2880,000. Okay, similarly, we do the same process with the other value. Then we have 189,000 by 0.075, and we have 2.520. So it's 520,000. Then we have COGS. It's not the same COGS that we have COGS and wheel. This is just a short form for cost of goods sold. And as you can really see that if you just subtract this from here, you'll just find out the value of cost of goods sold. So I'm going to be, because this is X, okay guys, so what do? You subtract X from here to find out this, so you subtract this. When you have net sales, you subtract the cost to get gross profit. So when you subtract gross profit from here, you get COGS. So it's 1,872,000. Okay. Again, we have, I can see 2,520,000 minus 1,134,000. And 1,386,386,000. 6. Hope that you can see it though, it's just too slippery. And when you subtract this, you get this value. So now you can just simply better understand if I put this sign here and you can just get gross profit from here per line. now you're in a better position to understand what I'm doing. Okay, we have operating expenses, so you can just simply subtract this to get this based on the same theory that we just applied above. It's just some common practice that missing figures can find out just by two known values can find out the third one. So we have less 2, 3 zeros. So we have operating expenses as 777, 600, and you can find out this as 1134,000 less 2520, and you have 882,000. Guys, as you can see now that in 2018 operating expenses are far below, so this is a good thing. I'm just putting a star where I find this is something good. But here COGS is way more, so it's a downward. Is it? I would just simply say it's just a negative thing. So it's a negative, simply negative. Because we have something a negative for the firm because they have a way increased cost of goods sold. So what is the tax now? Is you can find out from here. We have 230, 400 minus 172, 800, and you have 57,600. So this is the tax. In this case is for 2018 it's 57,600, and for 2019 it's 252,000 minus 189, you get 63,000. Now if you just divide them by respective, well, what is the percentage of with the respective sales? So by 20, you can have as 25%. And what is the percentage for this? This is 57,600 by 2,880,000. Let me just see. There's got to be some problem with this. I don't know what's the problem. 600. It's 2.5%. So this is 2% sort of. This is a way, if you just want to compare that with the sales, this is just a bit discrepancy, but that discrepancy could be because of the rounding of the figures. So it's just more or less the same. Tax percentage, I assume, is the same. It's very close. And you can also find out because when you have the tax as percentage of the net income, that you can just simply see how much tax, and also find out with the percentage of how much to be charged by. So you can actually find out percentages is 25% now. Okay. When you divide the tax value with this figure, you get 25%. And when you divide this by 63,000 by 252,000, you get 25%. So yeah, my guess was approximately this correct, that the discrepancy could be because of the some rounding off, but it's supposed to remain the same. So if you just divide to check from the tax value that you just calculated by subtracting net income from this figure, this was 57,600, and then you just divide by income before income tax value. So you just get 25%. So it's just the same. So if you have any identification problems with the rate, you can just cross-check from here. Unless and until there's some kind of a directive that the rate has changed, it doesn't do. So any kind of discrepancy here by dividing by sales, because you have to divide each figure by net sales eventually. That would also give you a value of what the common size analysis would be like. And then you can also divide with each for trend analysis. Now our base in this case is 2017, so you can just divide this value as a percentage of this value, keeping 2017 as a base, so you find out this is way more in percentage to this. And I think I've pretty much done all. We have favorable, unfavorable. Okay, so the last part is identifying the favorable and unfavorable trends. So I've already done this. This is a favorable trend. We have our expenses in control. We have gross profit, which is not too different or too, there's not too much disparity in this. And we have COGS, which is slightly more. And even then, we can say that our sales are more. But the sales could be because of many reasons. Again, I said that there could be some inflationary trend in the market. So our prices are more, but we have to control our costs, because then that would lead to operating inefficiencies. But since we have operating expense as lower, so we can say this is efficient. So the problem is perhaps with the cost being because of the supplier giving supply at a higher cost. So when you have this owing to higher costs, this would naturally be more. Otherwise, it could happen that maybe we just got more and the inventory was lying in the go down. But since, as we can see, the operating expense is not as much, so it couldn't be storage costs or it couldn't be safety stock. It's more to do with the suppliers giving them at a higher cost. So the solution to the problem is that we have to control our costs to have more profits, make more profit, and to have a higher net income compared to last year. So this is definitely a case of inflation as well, but we could find some substitute or find another supplier who could sell these products at lower costs. I'm going to be doing one more question for you guys. So it's just current assets and current liabilities. I've already discussed this with you. This is Rogan Grocery Incorporated, and we have so what I think is that we should okay, I'm going to be just doing it quickly. We have to find out current assets, current liabilities in this case. According to part A. So what is current assets? Current assets? And you are to make it in a form of a statement. I don't have space, so I'm just going to be writing it down. I can't reach that much on the top. It's a bit more. Now, as I said, we have cash. We have marketable securities. We have accounts receivable. You can maybe just write accounts receivable, marketable securities. Then we have, if there's any notes receivable, we can have that as well. We can have our unused insurance or unexpired insurance. We can have inventory. Okay, so we can just add in values with this. So the first thing is the cash, which is 69,400. Then we have marketable securities. It's understood that this is short term. As we've already done for asset test ratio, we have marketable securities. And guys, they're not the same as stocks, okay? Do know that. because stocks can't be treated as current assets, is 175,040. 040, and then we have accounts receivable. What is accounts receivable? Okay, so we have accounts receivable as 230540. Two three zero five four zero. Sorry, slipping. Then we have unexpired insurance and inventory. So inventory is we have 179,600. 600. And unexpired insurance as 4,500. And you can just simply add them up. So you have 69,400 plus 230,540, 175,004. So also sometimes we have current portion of long-term debt. So if they give us some kind of a mortgage for 15 years maybe, and then we can have that as a current payable for us. So that will be a current liability. Always remember this thing. And we have 4,500. And same is the case for $659,080. So yeah, the thing is, you should always know that for even if you have given someone leverage for 5 years to give you money, so that would be a long-term note receivable thing. But if he pays you something in the current period, that will also be counted as current asset. Then comes the liabilities. We have note payable within 90 days, 70,000. That's note payable. That is 70,000. Then we have accounts payable. $128,100. $100. Yeah. It's this. Then we have salaries payable, and that is 7,570. And do know that since this is a payable, otherwise if it was salaries paid, then that would be an expense reported in income statement and not in a balance sheet. So then we have dividends. We skipped that. Income tax payable. Okay, so it's 14,000. Yeah, 14,600.